Hi, this is Rod Fishkin from Keller Williams Realty, Northern Colorado. Back with 4 more ways for you to be able to reduce your monthly mortgage payment and make it more affordable. Following up on my last video where I shared 6 ways to reduce your monthly mortgage payment, I'm really trying to figure out and help you figure out ways to make homes more affordable on a monthly basis in this time of higher interest rates than we've been used to for the past few years. So let's jump into it. The first way that we're going to talk about today is to pay a fee to permanently reduce your mortgage interest rate. Lower interest rate equals a lower monthly payment. So this permanent reduction is sometimes called a rate buy down, or some people call it paying points. And what it amounts to is you pay an additional fee at the closing of the property to permanently reduce your interest rate. If you are going to be in a property significantly longer, then this could be a viable option. So in the long run, it's worth it to pay this fee. The next one is a little variation on that. So you can pay a fee at closing to reduce your mortgage interest rate for the first 2 or 3 years. Then after that time period, the rate jumps up back up to the regular predetermined rate. So sometimes this is called a 2-1 or a 3-1 buy down. So in a 2-1, your rate is reduced the first couple of years and then it bumps back up. In a 3-1, your rate is reduced for 3 years and then it bumps back up. So also, sometimes your real estate agent could negotiate that the sellers pay the fee for that temporary interest rate reduction. The third item is also a change to your mortgage, and this one is called getting an adjustable mortgage rate, or ARM, A-R-M. A lot of times people think of getting a 15-year or maybe more typically a 30-year fixed rate loan. But in an adjustable rate mortgage, the interest rate is usually significantly lower the first maybe 5 or 7 years, and then it goes back up to whatever the current market mortgage rate is. So in an example of a 5-1 ARM, the first 5 years are at a lower fixed interest rate. They don't change during those first 5 years. And then starting in year 6, the rate bumps up to whatever the current market rate is. So if you think rates are going to stay the same or go lower, then you're taking a bit of a risk. But if you think rates will be lower or the same in, let's say, 5 years, then it might be worth it. And then the last tip that I'm going to give you, number 4, is really more about property insurance. So for your homeowner's insurance, or it's also called property insurance or hazard insurance, you want to shop around for this. Look for low rates, also with great service, and a really good reputation. And sometimes you can bundle your homeowner's insurance with car insurance to get a net savings. So this is worthwhile and worth doing because if you remember, property insurance is usually part of your monthly mortgage payment. It's kind of bundled in and wrapped in with that. So if you reduce your insurance costs, you'll have a smaller monthly mortgage payment. So again, like I mentioned last time, I am a real estate agent with over 12 years of experience, and we've helped over 400 clients. But what I'm not a mortgage lender or credit repair expert or a homeowner's insurance expert. So the info I've shared here with you may not apply for your exact situation. If you have questions or want more information about this, give me a call, text, or email me, and I can connect you with a great lender or a home insurance expert who can explain this all to you in more detail. Here's my contact info. I hope this is helpful for you. Hope to hear from you soon. Thanks.